Hello, this is Mike Swanson. I run the website wallstreetwindow.com. I've got a very special guest with me today. I'm speaking with David Skarica, who writes addictedtoprofits.net. How you doing today, Dave?
I'm really good, Mike. How are you doing?
Oh, I'm doing good. It's been a fascinating month in the financial markets, and really this past week has been very remarkable. We've seen a surge in the Treasury bond prices. The yields have collapsed. The odds of an interest rate cut have dramatically increased this year. Gold has gone up. But today, the stock market is up, the Dow up almost 500 on the close, because this morning, Jerome Powell spoke, and he basically said that the next time there's a slowdown, he is ready to lower rates to zero. He's ready to start a new quantitative easing program. In fact, he said that that should not be considered unconventional, but now a normal part of Federal Reserve policy. So that's helped bring buyers into the market. And I'm sure tonight Kramer is going to be very excited. And so what do you think? Do you think people should just dive in, buy their Apple, buy their NVDA, and some of these other stocks have been doing very bad, or try to buy gold and do something different?
Well, I think that, first of all, like, your topping or bear markets are a process. And one thing I've noted is that, in 1987, the whole crash didn't even last. The whole time frame of the crash was actually 55 days. And that's not even trading days. That's 55 total days. So basically 2 months. And, the 1990 bear market, which was a mild bear market, was a couple months too. I think it started in July and ended in September, October of 1990. But it seems now that these bear markets are now taking a long time to form and top. So if you look at 2000, essentially the market topped from early in the year, about March, till, the fall. And then it really didn't break the spring lows until late in 2000. So it took almost, it took 8-9 months to top out. And same thing, if you look at even 2008, it didn't really break down to the fall of 2008, and the market topped in August of 2007. It was a double top roughly with the October high. So it took basically a year for the markets to top out. Now, granted, they fell along the way and had rallies. So I think part of it is because what you're seeing right now in the Fed now is reacting much quicker than they did in the past. And they're so ready to bail out the market, it causes the tops to be longer, and then it takes longer for the market to fall. I think because of that, because they are actively almost like supporting, the market. So that, I think that's one reason. So even if you're someone who's bearish in the market, it's going to take a while. And if you go look again, 2001. Or 2007, the first few rate cuts or cuts are the ones that are the most efficient in terms of driving the market higher. Like after the Fed cut a few times in the first quarter of 2001, there was a really good sized rally into May of 2001. And in 2007, after they cut in August, there was a huge 2-month rally where, again, the market went to new highs in October of 2007. So I would say, again, topping is a process. Some stocks are acting weak, but I just don't think this is going to be a straight down affair, and it's going to take a while. And in terms of buying Apple, I would think the news that came out on Google with a potential government action against them in terms of like a monopoly type action, that's a huge deal, because one reason that tech stocks often have higher premiums and multiples than the rest of the market is they don't have this discount for government intervention in them. Tech is probably one of the few sectors left where you don't have a whole lot of regulation, especially in these like social media giants. And kind of what ended the tech bubble in 2000, or one thing that coincided with it, was Microsoft have an antitrust lawsuit from the government back then. So if you were to get an antitrust lawsuit now on Google, I think all of a sudden everyone would be looking around. I think it's one reason Facebook fell so hard yesterday, to saying, oh, well, now these companies like Amazon, Google, Facebook are not immune from government action, and then you have to almost adjust the valuations because they're just not going to be able to do whatever they want anymore.
Well, once it does seem certain at this point that an interest rate cut is coming. I know, the odds can change day by day. The rally today actually is diminishing the odds of a cut this month. Now it's 77% no cut. but the odds of one by September are still 91%, and even July at 64%. So if the Fed does lower rates, can that cause an explosion in the Dow to go up to a huge level from here? Or do you think people should buy gold or something?
Well, if you go look at when they cut rates in 2007, even though the gold stocks crashed with the market in '08, or when they cut in 2001, in each case over the next 12 months or so, that means like the summer of 2007 to the summer of 2008, and 2001, really for almost the rest of the decade, other than when they fell in 2008, but really for the next 10 years into 2011, the gold stocks had great rallies, especially, let's just take '01, '02, did very well while the Fed was loosening. So, and even after the crash in '08, when they dropped rates to zero, well, gold has lagged in recent years. In that first phase of the bottoming of the market in '08, '09, the gold stocks were really the first sector off the bottom, and the first sector almost back to new highs, by the way, in 2010. So I would say if they start lowering rates, especially with the depressed nature of gold stocks, them trading more like they did in 2000, in 2007, 2008, I would be more inclined to buy them because they're so cheap compared to the rest of the overall market. And now, like technically, you're right, getting back to that 1350 to 1400 level, which is the key technical resistance. And if you can blast off out of that, and I think a couple of rate cuts is what would be the catalyst for that to happen. Yeah, I would be looking at these gold stocks rather than the other stocks, because the problem you're going to get right now is, let's say this is like 1999, and there was a correction in '99 in the stock market, the S&P, from about that summer into the fall, and then the huge blow off started from October into March of 2000, October '99 to March of 2000. So let's say something like that happened. Well, okay, the many equities would do well, but probably the gold stocks would trade higher with the market if that happened. So you would still have just as much upside in them as you would have the rest of the market, right? So, so the long answer, sorry, I explained why, but the short answer is, yeah, I'd still be more inclined to buy the gold stocks here. And partly is the equities, or especially U.S. equities, are just so expensive. Other than buying select sectors or an individual equity, because maybe it's got some unique opportunity in it, I just don't want to really own the whole market at these valuations right now. Like one thing I've been doing, and you've done it with me, is I own some of these small cannabis deals, and I've been buying them pre-IPO, in kind of a venture capital way. And then when they, trade, that's a sector that's hot right now, and they trade, they came out at big premiums to where you bought them pre-IPO. Sometimes you got to wait 6, 12, 15 months for them to trade. But I'm more comfortable doing something like that because I know I'm not just sitting there trying to make another 20% in the market. That's something where I'm trying to make 200, 300, maybe 1,000% on my money if it comes out good. And the risk is worth the reward in that case. So again, it have to be very unique opportunities. But no, other than if you're a day trader or something, I wouldn't be out here buying Google, especially with the antitrust lawsuit looming.
Well, what about Uber? That's a stock that's brand new.
No, those stocks are all bubbles. Like we've talked about this. One problem in the cannabis market is you do have bubble-like valuations. But when you're buying, okay, let's say you got a company in cannabis that's going to have $20 million in sales next year. A company like that might have a $200, $400 million market cap, depending on the promotion, the quality of what they're going to produce, et cetera, right? So they're trading at 20 or 40 times their revenues, right, for a year out. That's an excessive, valuation. But the difference is when you're buying pre-IPO, you're probably buying that company at a $20 million valuation. So you're buying the company essentially at 1 times revenues when you're buying it pre-market. Now, if you could buy the Uber IPO a few years ago at a few dollars, fine. Again, in a private funding, but there's no way you can buy Uber or Lyft. And again, they're trading at these huge valuations, price to revenues, and they're losing a ton of money. I think one thing that was different about Facebook when it came out is that Facebook is a very profitable company, right? It's not one of these IPOs that's burning through cash, that's losing a ton of money, et cetera, et cetera. And another thing too is I think the business models of those companies are, for lack of a better term, bullshit. I think that if you go look at Uber and Lyft, the only reason you can say get an Uber or a Lyft, everyone acts like they revolutionized the world and are so much better than taxi cabs. But the reason they charge what they charge is because they've raised so much money in venture capital, and they have this like slush fund that they can eat through, and while they lose money charging cheaper rates, right? If they had to make money or just even be neutral in profit, like break even, they would be charging the same rates as taxis. The only reason that they can they charge those cheap rates is because they have all this money they've raised and they can burn through that money. So they haven't revolutionized anything. I think actually those stocks are almost like scams in a way because they're just using cheap money to support a flawed business model.
Yeah, well, what about the argument that there's other companies losing lots of money that have stocks that are fun, like Netflix? They lose billions, and people recommend them all the time.
Well, the difference in Netflix is actually Netflix does make money. They do have a high cash burn rate. And again, I would say they actually have a more sustainable model. Now, I don't know if they can always, because they're using cheap money to fund all these shows, but they have this model where they produce movies and TV shows, and it's subscription based. And if you notice, Netflix has been raising their rates recently. So, because they know that their model was a little unsustainable before. Now, it's got a ridiculous valuation. I wouldn't buy it, but I would just say the setup of it isn't as scammy as Uber and Lyft, right? And the thing about Uber and Lyft, Netflix does have a unique advantage in that they do have all this content now, right? And they have these shows which have loyal followings and whatever. Well, Tesla, I don't like Tesla, but Tesla's talking about coming up with a driverless car to compete with Uber. Now, I don't think Elon Musk can be able to do it because, he's got his own financial problems with that company. But let's say he did. Then boom, all of a sudden you've got competition for Uber just like that. And that's a much easier market to break into than say, because all you got to do is find some way to transport people from point A to point B, than Netflix, where when people are watching something like that, you have to have very unique content to draw viewers, to your platform. It's like why do some channels have high ratings and some channels low ratings on TV? Because the channels and the things with high ratings are stuff that people want to watch. Well, creating content that people want to watch is very, very difficult.
Yeah, for sure. Well, right now, what's got your most attention in the market as far as a potential way to make money going forward, or an individual stock or sector, or what do you think is real interesting?
I don't really want to give it away, but
okay, don't worry about it.
No. I got a book coming out where I talk about it, but I will say this: I think one of the unique opportunities out there. There are a whole bunch of stuff, emerging markets, and there's certain stocks are really cheap. I will give one away. If you look at a stock like VIV, this is the telecom operator in Brazil. This trades a near 7% dividend, single digits price to earnings. So if the Fed begins to cut rates and this helps emerging markets outperform, that's a stock that do really well, and it's really cheap. But there's two stocks in particular when I'm looking at one of the big developments in the next 10 years is going to be 5G. And because of all the worries over Huawei in China, a lot of countries are turning their back on them. Not just the U.S., but European countries, India, Japan. Japan and India do not get along with China. And there's two companies that are based in Europe that are setting up 5G networks themselves, and that is going to be $1 trillion industry. And these are two companies you probably actually would know who they were, but I'm not going to give them away. Like I said, this is for my subscribers and for when I release my book. But I think those may go down if you get a bear market, but in the next 10 years, I think these are two great companies to own, and they're way cheaper than all of these other tech companies at the moment.
Okay. Well, we'll have to do an update for sure once your book is out so people can get it. But I'll know you're busy and you
Yeah,
got to take off a few minutes.
yeah, I'm just editing it right now, so it probably won't be out for a few months, but yeah, we'll tell people about it when it comes out.
Okay, great. Well, thanks for taking the time to talk to me and everyone else. We'll do an update soon.
Okay, thanks.